Hello, my name is Meaghan Wingbermuehle. I'm a senior manager at DHJJ and the leader of our state and local tax group, or SALT group. Today I'm going to discuss the specific types of state tax forgiveness. Here's a list of the most common types of state tax forgiveness: amnesty, tax holidays, voluntary disclosure agreements, or VDA, and offer and compromise. Amnesty is an act of pardon or governmental decision to not punish a person or company. It's a limited time opportunity for taxpayers to come forward and settle outstanding tax liabilities related to a previous period. This can be done without fear of criminal prosecution. Usually, amnesty will limit or waive interest and penalty. Additionally, amnesty limits the amount of time to file the returns or correct returns and pay the tax. If a taxpayer should have participated in amnesty but did not, and later it was discovered that they should have, the state sometimes will reserve the right to double the interest and penalty on the tax due that should have been paid during an amnesty period. Amnesty usually excludes people from participating if they are currently under criminal investigation, if they have provided false information on a return application, etc., or if they've been issued a final assessment with the appeal period ended. If a taxpayer participates in an amnesty program, it does not preclude them from being audited. There are many types of state tax holidays. Tax holidays are usually a set date and specified items that are exempt from sales tax. One of the most common state tax holidays is back-to-school tax holidays. This includes non-commercial retail purchases of school-related items from sales and use tax. This is school supplies, school clothes, computers, shoes, etc. Usually it's set over a weekend in late July or early August, and sometimes they'll even set an exemption limit, for example, a threshold of up to $200 of a purchase. Below is listed the states that usually participate in back-to-school tax holidays. Another type of state tax holiday is disaster preparedness tax holiday. This includes portable generators, portable radios, flashlights, smoke detectors, first aid kits, and again, usually a threshold is placed on this. Florida just had theirs for 2020, and other states that usually enact this holiday are Alabama, Texas, and Virginia. Another state tax holiday that we are seeing more common are energy efficient tax holidays. This includes appliances, heating equipment, lighting, etc. Usually it's non-commercial use, retail purchase of Energy Star qualified products, WaterSense products, and other energy efficient products from sales and use tax. Maryland, Missouri, Texas, and Virginia all had their own program in 2019 for a few qualifying days. We expect them to have days in the current or future years as well. A state may offer a voluntary disclosure agreement program for taxpayers subject to that state's taxation or having tax collection responsibilities with tax due. This affects a taxpayer who is determined to have past exposure to a state tax that they have not filed or paid. They may be able to take advantage of a voluntary disclosure agreement program in order to become current with the state. A company may qualify for different types of taxes covered under the voluntary disclosure program. Very often seen are corporate income tax, corporate pass-through tax, individual tax, and sales and use tax. Usually a state will waive the penalties as well. They will also usually set a look-back period of the tax owed. This is important because if a taxpayer has never filed in a state, the statute of limitation never begins running, leaving all past years open. A company may also use the Multi-State Tax Commission application for member states. Some typical requirements of the Voluntary Disclosure Agreement are tax returns have not been filed within the state in the past or within a set number of years. The taxpayer is not currently registered with the state for disclosed tax type. The taxpayer is not under current audit, examination, or criminal investigation. There has not been any contact with the taxing authority or its agent. They must provide financial reports and records. Failure to report or pay tax was not due to fraud, tax evasion, gross negligence, or willful disregard. An agreement to pay the taxes owed, file the prior returns, and keep the account current moving forward. This is usually the information that you will need to include in your application. Usually applications are done anonymously and done through a third party such as your CPA. Offers in compromise are agreements to pay the tax debt for less than the amount owed. These are made between the taxpayer and the state revenue department. The state will consider if there is a doubt as to the liability, if there's a doubt as to the collectability, or if the collection of the full liability would create a financial hardship for the taxpayer. Generally, the taxpayer will initiate the offer and compromise process by contacting or applying with the state taxing authority. Additionally, all returns, filings, business licenses, etc. must be filed and current with the state. This information is usually included in the application process. The completion of any official forms by each state, copies of financial statements, state and federal tax returns, any IRS offer and compromise agreement in place, lease agreements on any owned or leased property, mortgage statements, any bankruptcy discharge orders, and credit reports. And at any point, anything else that the state deems relevant for an offer and compromise. Thank you for listening to this topic today. If you have any additional questions, please reach out to your DHJJ CPA. I hope you have a wonderful day.